Today, we're going to be going over the second quarter market review and the investment forecast, not only for the rest of 2018, but also beyond. There's a lot going on, so I'm so happy that you've taken the time to invest in yourself. As far as what we're going to be going through, make sure that you have a pen, a paper, and we're going to be going through a lot of information. But what we have done is we've taken to break it down into understandable, digestible pieces so that you feel more informed and you know where you stand. We do this on a quarterly basis because here at Francis Financial, we know that the more information we give our clients and that we give out into the world, the more education there's going to be. And we can all agree that knowing more about finances, knowing more about money, it's just a win-win. But as we go through here, if there are any specific questions you have or you want to dive further into any particular topics, I please invite you to reach out and we'll customize your answers specifically not only for you, but for your financial situation and your financial investment portfolio. So thank you for being here. We're going to go ahead and get started and talk about what a crazy year it's already been. So this is our agenda. We're going to be looking at what's happened so far in 2018. We'll be looking at that investment outlook going forward. We're going to be talking about this webinar, the specific money mistakes that we are seeing occurring over and over again. And we want to make sure that you're not one of those people who finds themselves falling into that trap. And the final piece is going to be talking about the complex, very, very decisive conversation that we're seeing in the press about active investment management as well as passive investment management. And so that's really just talking about mutual funds. What's the right one for you? Is it a more active mutual fund or a more passive mutual fund? We'll be going through to figure out what the most economical, best return structure is for you and your portfolio. So the one thing that I think we can all agree with is that a lot of the newspaper headlines out in the media are really, really confusing. In fact, we picked a couple that were in the exact contrast to one another. So one of them that we picked out was talking about the NASDAQ and really talking about how Facebook, Netflix have done phenomenally well, that they're at all-time highs. But just a few days later, they said the FANG stocks, so Facebook, Apple, Netflix, and Google, that's what that FANG stands for, that's not where you want your money. In fact, move your money to small cap. Definitely very confusing topic there, and you're getting mixed messages. More mixed messages out in the newspapers and on TV about the economy. In fact, one of the headlines we saw from this last quarter was that the U.S. economy has plenty of steam. Don't worry. Don't worry. The U.S. economy is doing just fine. But below that, you can see there are a complete different view and talking about that there are economic concerns. And because of these economic concerns, the Fed should stop its expansionary policy, its easing, and instead not raise interest rates. So two things that are the direct opposites. Now we saw this also not only with those tech stocks that we talked about, Facebook, Apple, Netflix, and Google, not only with the economy, but we also saw this with emerging markets. Talks about a emerging market rebound. You can see in that top headline, and then you can see at the that the area right below that in the direct contrast. So there's definitely mixed messages that we are all hearing on a daily basis. And what it equals out to is, unfortunately, it equals out to a lot of confusion, a lot of anxiety, and understandably, a lot of fear. So, what actually did happen this last quarter? What parts of the market did well? What parts of the market didn't do so well? So, over the last quarter, and so that second quarter, just so you know when that starts, that's from April 1st, 2018 through the end of June to June 30th, 2018. We saw that the US stock market was up almost 4%. You can see 3.89%. But look at all the other parts of the market. International developed stocks were down. Emerging market stocks were down. Even steady, the US bond market was also down. And so, based on that, what does that mean for you? What does that mean for US stocks? Well, what's interesting, we just saw that US stocks were up nearly 4% in those 3 months of the second quarter. You can see that right here, that beautiful growth in the second quarter. But what's interesting is that's not the whole story. You can see that the beginning of the year, US stocks did pretty darn well in the month of January, but had a dramatic drop in February. In fact, I remember that day extremely well because I was on vacation. But as the market often does, if you're on vacation, you're not ever really on vacation. And so there I was skiing with my kids up in Vermont and finding myself looking at these headlines, knowing that our clients were probably pretty darn scared, logging in and making sure that we were sending an email and reaching out to those clients to talk about what's going on in the market. Now, what you saw there after this dip, there was a pretty big recovery, which is wonderful, but yet another dip in March. So the first quarter of the year, stocks didn't do so well. In fact, you can see that US stocks were actually down. It's the second quarter that they've really peaked back up. So year to date, how have they done since January through the end of June? Well, not so bad. Despite that rocky start that we see, we're still at a nice clip upwards, and we've seen US stocks do well at 2.6%. Now, the big news is actually for small company stocks. Small company stocks have done even better. So this last quarter, the second quarter, small company stocks roared forward, almost an 8% return in 3 months. I don't know about you, but an 8% in 3 months, that is a phenomenal return. And year to date, you can see that they're doing very well. They had a slow first quarter, just as US stocks had a slow first quarter too, but still they're doing really phenomenally well for the year. And year to date, you can see that small company stocks are up 7.7%. Now, this compared to these larger company stocks that you see here, larger company stocks for the year, as we mentioned, are almost at a 3% return. Now, a question that you may have is, why is there such a difference right now? Why are we seeing such a big difference in 2008 between companies that are what's considered large companies and smaller companies? Well, there's actually a very good reason, and this is it. Small company stocks such as Sonic, Scholastic, American Eagle, Shake Shack, FYI, Shake Shack is not going to be a small company stock very long. Based on my family, we're boosting that to mid cap, I'm sure, because of the number of times we go there. And we're trying to be a little bit more healthy. Unfortunately, our children are not really on board. So we'll see. And needless to say, Shake Shack has some really strong followers. My idea would be to have them move out of our neighborhood so we wouldn't necessarily have to go there as much. But I do have to say, I don't know if you've tried their shakes, but their shakes are really good. But what is in common among all of these companies that you see here is, yes, they're small company stocks, but there's something else that's in common is that they're mostly here in the US. They're mostly domestic. They don't have a whole lot of operations or exposure to other international countries. So, because of that, they're not as exposed and impacted by all of this talk about the trade war. So, that's part of the reason why small company stocks, in some ways, have become a little bit of a safe haven because they're not nearly as impacted by the ups and downs in the market that are being fueled by these trade war worries. Now, what about bonds? Now, we remember that bonds did pretty much flat, a little bit down over this last quarter. So, why is that? Why did we see the reduction in the reduction in value of our bonds? Well, it's because of this. Because when interest rates go up, guess what? Bond prices go down. And so here's a wonderful, wonderful chart. And I'm going to look at the left-hand side of your screen. The left-hand side of your screen shows a scenario of what we're seeing right now and what we expect to see going forward. And that is interest rates going up, interest rates rising. And what the relationship is that when interest rates go up, the price of bonds go down. And so that's essentially what you're seeing. And a good example, a very good example of that is that if you bought a bond issued by Coca-Cola 3 years ago, and that was paying you interest of, let's say, 3%, and Coca-Cola issues a new bond today after there's been a couple interest rate rises. Instead of 3%, they're now offering a 4%. Well, you as a savvy consumer, if someone was offering you $3 versus $4, which one would you take? Well, you'd take the $4. Well, as would any other rational investor. So that means that your Coca-Cola bond paying 3% doesn't look so appealing anymore. And so the price of your bond is going to go down. In fact, it's going to go down because the typical investor isn't going to pay as much for that bond as they would pay for a bond giving them a higher coupon, a higher interest rate. So this is the dichotomy, and this is also why we see that there's downward pressure on bonds and why it's a little bit harder to make money in bonds. Now, don't worry. We're going to be talking about what you can do with your bond positions and how you can ensure that the interest rate rises that are surely going to be happening over the next several months and next couple years, that your portfolio isn't whipsawed too negatively by it. So don't worry, but you're going to have to wait till the end to get that information. So let me jump to this. Let me talk about international stocks. I feel like the news today, you almost need to take a Prozac, or I'm not sure all of those other anxiety reducing pills, not remembering all their names. I think maybe Zoloft might be another one. I feel like you almost need to take that pill before you turn on the news because the international arena and the news coming across the globe is quite anxiety producing. We talk about trade wars, we talk about political unrest. There's a lot going on. And over this last quarter, we saw all of these fears and worries actually take shape in the market. So this is a wonderful chart. And what we've done is we've tried to make this as clear as possible. So emerging market countries, we've gone ahead and circled in red. And developed international countries, those that are further in their development stages, are circled in that beautiful teal color. Overall, emerging markets during this time were down almost 8%, as we talked about, and developed international pretty much flat for the last quarter. But where did we see the biggest drop-offs? Well, for emerging markets, you can see pretty clearly that we had some really significant drop-offs, particularly by Brazil, South Africa, and the other emerging markets that were able to hold their ground and not necessarily be quite as impacted. Mexico, China, Hong Kong, even Russia had positive returns. Now, for us, we actually don't invest in Russia despite the positive returns because of some philosophical reasons and also because of a lot of the concerns that we have, as well as our clients have, about that country. However, for developed international, it's a different story. That was a little bit more flat, but we saw the biggest losses coming particularly from Spain. We saw a little bit in losses from Europe, the UK, Canada. However, France really actually was one of the better performers. So this is interesting because it's interesting to see on a country by country basis. And the way that we invest is also looking at not only the part of the world, but what particular country, and do we want money to be invested and exposed to that? So why did we see these market woes? Well, there were two key factors. The trade war fears, which we've already talked about, but also the strong dollar. Now, the strong dollar is interesting because it actually has had a much bigger impact on the international stock market arena than the trade war fears. But what's interesting is that you don't really see it talked about in the same way when you open the Wall Street Journal or you happen to be flicking by Fox, PBS, whatever it might be. So what I'm going to do is show you a little bit about why the strong dollar, the strengthening of the dollar, has had such a big impact. So over the last quarter, what we have seen is that all of these currencies, pretty much every currency in the world, has lost value compared to the U.S. stock market. In fact, there's only one country who's had its currency strengthen against the U.S. Which one? Guess. Yep, this right here, the Hong Kong dollar. So what does this mean? Well, it means that if you are traveling to Sweden, the Swedish krona is now 6.38% devalued compared to the US dollar. So that means that if you're traveling to Sweden, you're probably pretty happy. It means that your dollar is going to buy more in Sweden than it would have last year. But it's a problem for any Swedish tourists because when they come and they convert their dollars from krona to US dollars, they're going to get fewer US dollars for the same number of krona that last year would have given them more US dollars. It means that visiting the United States becomes more expensive. So why is this an issue? Well, it's a really big issue. And part of it is many of these countries have debt. And repaying their debt that's denominated in US dollars all of a sudden becomes more expensive. So if you owe $100 in US debt, so US dollars, and your currency just got devalued by 10%, instead of it feeling like you're paying back $100 of US debt, it feels closer to like having to pay $110. It essentially means that paying back debt to the US is more expensive. It also means that buying goods and services from the US is also more expensive. So that's another piece that makes it much harder for a lot of countries to be able to import the goods and services they need to produce their products because, well, they're more expensive. And this is actually, I put together an interesting chart to talk about this specific debt piece. And here we have for Mexican pesos. So assuming a country in Mexico gets a loan for $20,000 from the US. That company takes that $20,000 US dollars and converts it into pesos, and they have 100,000 Mexican pesos. They invest it, they could put it into research and development, and the amount that they owe is that 20,000 of US dollars. But when it goes back to pay back that money, if the dollar appreciates, all of a sudden, instead of needing to use 100,000 pesos to pay back that $20,000 loan, they now need a lot more. They need 120,000 Mexican pesos. It's the same thing as we talked about it being more expensive to have international countries buy goods from the US. Originally, a ton of steel could be purchased for $2,000, translating into needing 10,000 Mexican pesos to be able to purchase that 1 ton of steel. With the dollar appreciating in value, well, now they need 12,000 pesos. That's the equivalent now of $2,000 to buy that 1 ton of steel. So really, the strong dollar that we're seeing can be very positive for us in many ways, but also has some very negative implications for our international neighbors. It also has some, negative implications for us because it means that this will potentially over time increase our federal deficit. Because as goods and services are more expensive to purchase from the United States, I don't know about you, but when goods and services become more expensive, I tend to spend less. A great example. I go to the fish market in Whole Foods, and I know that there are certain fishes that are much more expensive than others. And while I still try to go ahead and buy those more expensive fishes when I can, I find that my buying behavior, I tend to buy more of the less expensive fish. And so does everyone's buying behavior. So this is an issue. It's something that we're very concerned about because over time, we can see that there will be a additional ballooning of the federal budget deficit. Now, do we expect the US dollar to continue to strengthen? Well, because of this concern of an increasing federal deficit, we actually expect that the US dollar will not continue to strengthen. In fact, we expect it will weaken. We've also seen from Trump in one of his many, many tweets. As we know, he's very good at that. In fact, to be honest, don't judge me. I actually don't even know how to tweet, but he seems to prefer a weaker dollar as well. So based on a lot of different factors, we expect that the international stocks, both international developed and international emerging markets, will recover, but they have some headwinds, and that is those increased trade war fears and how those played out. Well, China, for example, despite many of those trade war fears being trade war comments being directed at China, you can see China actually did relatively well compared to some of its peers. And part of it is, and this is something I want to share with everyone here on the call, these talks about tariffs are not new talks. They've already been priced into the market somewhat. So that's something for you to know as well, that there's already a lot of fear and anxiety, and that this uncertainty that we see ahead has already been impacting investors. Because when there's additional risk that's perceived in the market, people move to safer assets. And so that's why we saw, particularly during the second quarter of this year, individuals moving from risky emerging market stocks. And I really want you to note that. Do you see the word risky, how we have that in quotations? Because emerging market stocks do have some additional risk. But as you're going to see, as we dive further into what's really going on with emerging market stocks, you will see, interestingly, that emerging market stocks are much, 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 much more attractively priced compared to US large company stocks. So, really, what's more risky? So, stay tuned because we're going to be going through each one of those pieces. And so, what is our outlook? Well, our outlook is cautiously optimistic. Cautiously optimistic. And I feel like this picture says it more than any words can. That, well, we have optimism. We still have a very strong economy. We have a lot of wonderful tailwinds moving us forward, but there are some concerns. And so that's where, with our investment outlook, that we are concerned, particularly about U.S. stocks. And how we look at U.S. stocks is looking at their price to earnings ratio. And you can see the abbreviation here. It's called a PE ratio, price to earnings. And quite simply, it's the price that the stock is trading for of that company compared to the earnings of that company. And the higher the price to earnings ratio, as we saw peaked a few months ago for the stock market, the more expensive U.S. stocks are. And you can see the historical average here. So we've included that 10-year historical average. And the performance of the market, both right after 2008, when after that drop, U.S. stocks become much more attractively priced, or what you might call much cheaper. And that over time, that recovery from 2008, that we've had that march upwards. We had that in 2010, 2011, 2012, some more bumps down in the market. And then from that period, that steady recovery that has been something that has been talked about over the last couple years of when is the bubble going to burst? Because we can see that overall we're significantly overvalued. U.S. stocks are overvalued. You're having to pay a more expensive price today than you have had historically over the last 10 years. So that's something that we're thinking about as we tweak our exposure to U.S. stocks, because we want to make sure that we're not overpaying for stocks when we can be getting better price stocks in other parts of the market. And one of the area where there are more opportunities is in small company stocks. Now, remember a couple slides ago, we talked about how small company stocks have done so far this year in 2018. They've done phenomenally well. They've done almost an 8% return, which is, again, really, really phenomenal. Well, what's interesting about this is that the case for small company stocks is not over. In fact, you can see right here, we've got that 10-year average for the price to earnings, and you can see where small company stocks are. They're actually very well priced. They're at their 10-year average. So we're really enjoying this. Small company stocks have not necessarily been a great place to be over the last couple of years, but we're seeing now that with their attractive price, there's a lot of value, and we are increasing some of our small company stock exposure. And we're doing that two different ways. If a client is underexposed versus where we want them to be, then we're actually doing that tweak and adding more. However, the other way that we're doing that is that because small company stocks right now are the fastest growing area of our client's portfolio, what we're doing is we're not trimming it back. We're letting that grow to be a little bit more because, again, the opportunities in this area look very significant over the next couple years. There are some other areas that look really interesting. And you can see even in Europe, despite Brexit concerns, that it's relatively well priced. In fact, they are undervalued and extremely well priced compared to the US. The average price to earnings ratio for the United States, if you remember, it's a little over 20. You can see that for the UK, France, Switzerland, Germany, and Spain, they all are significantly better priced than US stocks. You can see then here for Asia Pacific, Japan, Australia, Hong Kong, Singapore, all again extremely well priced, especially compared to US stocks. What about emerging markets? You can see that emerging markets are all in that same camp as well. So a lot of opportunity, and so that also is part of the reason why we're not trimming back our exposure internationally. There are great values to be had, and we're just being careful that we don't take on too much risk. So that's kind of the balance that we're taking, is making sure that we have good exposure, but not too much to add too much risk to the portfolio. So we talked about the biggest problems, the biggest mistakes that we see. This is the number one mistake. And there are hundreds and thousands of research papers written all about this. They refer to it as behavioral finance. But really what it is, it's emotional investing. So here's a fantastic cartoon of a little boy asking, Dad, how does the stock market really work? And Dad was telling the truth. He said, you put your money in it, and then for some reason you lose money. And then you panic and sell. And someone who's smarter than you buys and makes the money instead. So instead of hanging on to something after a loss, panic and selling. And someone who's smarter than you, they go in and they buy it. They buy it at those low prices, like we're seeing low prices for small company stocks, low prices in the international arena. And those are the people that then make that money, make your money. And what does that look like? Well, the emotions of this look a little bit like a roller coaster. And the emotions of selling low and buying high are exactly this, that when you start to see the market go up, you have optimism, excitement, thrill, euphoria. And as you see the market at the highest levels doing the best, it's interestingly enough, you don't realize, but the highest risk. And as you see the market come down, you start to see anxiety, denial, fear, depression, panic. Questions like, should I be a long-term investor? Oh, what should I do? Well, I'm going to sell. When what's interesting is that's the time for the highest potential of earning. Because at the lowest time of the market, in fact, I just saw a wonderful portfolio of a potential client who came to us, and we're doing a second opinion. We're reviewing every single holding and doing an X-ray analysis to see where they are, what needs to be tweaked, what things need to be done. And I looked at the cost basis. It was phenomenal. He had put $1,700 into Apple right after the drop in 2008. And that holding has increased to well over $100,000 in the 10 years from 2008. That right there at the end of 2008 was the highest potential for earning. Buying things when they're on sale is always much better than when they're overpriced. So let us do a case study. All right, so this is a chart. Now, we just looked at this for the second quarter from that April to June time period. If you tuned into a webinar during the beginning of the year for the first quarter, from looking at January through the end of March, you would have seen this chart. And what's interesting about it, every single part of the market was down, except one. The only part of the market that had a positive return from January through March in 2018 was emerging markets. And we had quite a few people telling us, you know what, let's throw it all into emerging markets. Take those dollars that are in developed international, because here we go, developed international didn't do so well. Take it from there. Take it from our US stocks. And in fact, put it into emerging markets because they've done so well. Well, had you done that, would that have been a good thing? The answer is no. It would have been a really big mistake, because remember what happened this quarter, the second quarter, those emerging market stocks that did so well in the first quarter had a reversal and did poorly in the second quarter. This is the reason why you do not want to be an emotional investor, because those emotional investors from the first quarter that moved their money to emerging markets would have been very unhappy. Making sure that the portfolio you have is a well-rounded, diversified portfolio, that is the type of investor you need to be. So now I told you at the end that I had a treat for you, that we were going to go ahead and tackle this unbelievable controversial fight about what's the best way to invest. Is it investing in an active mutual fund that's a little bit more expensive, where they're picking certain stocks and saying no to others? Or is it better to have more of a passive approach where there's still screens and picking here and there, but there's not that ongoing significant cost of saying yes to this and no to that? In fact, I have a really interesting chart to explain what the differences are. So a mutual fund or an exchange traded fund, the way you can think about it, it's truly just a basket, and it's about what you decide to put in it. And for an active mutual fund, you have a fund manager that is very active. You're very much dependent on him. And the reason why I say him is that, well, the majority, over 90% of the fund managers are men. So for him, you're really dependent on him being smart enough to pick the right stock and make sure you don't pick the wrong one, and that you sell that stock at the right time and you buy it at the right time. Whereas for a more passive approach, you're not so dependent on the manager, because there's a set criteria of what's invested and it's less focused on that manager. The trading costs, because you're buying and selling more actively in an active mutual fund, well, the trading costs are higher, whereas passive, they're lower. Active mutual funds tend to be more swayed by emotions and bias, whereas passive, remember, you've got that criteria. You're holding what you're holding because you said you're going to hold what you're going to hold. And performance relative to the S&P 500 or its comparable benchmark, well, the majority of those active mutual funds with those managers underperform over time. Whereas passive, they're pretty much matching what that benchmark should be. That makes sense. And the fees, well, active management, you don't get that for cheap. You pay higher costs. And that's actually part of the reason why the vast majority underperform, because they have to make up for higher trading fees. They also have to make up for higher costs. Whereas passive, we tend to see that the costs are much, much lower, and the trading fees are extremely minimal. So, what's better? This is an interesting chart, a little cartoon, and essentially, studies have shown, this is a paid commercial, studies have shown that monkeys can pick stocks better than most professionals. That's why Dogbert Mutual Funds employs only monkeys. Yes, yes, our fees are high, but we don't apologize for hiring the best. And let me show you this. In fact, active large cap core mutual funds earned 1.59% so far in 2018. We compare it to the benchmark that you would put that against. Well, S&P 500 outperformed it significantly, almost increased its performance by double of what we saw in the active management camp. Not convinced? Well, let me tell you this. A third of active mutual funds, less than a third of active mutual funds outperformed this S&P 500. So 2/3 of active mutual funds, more expensive mutual funds with higher trading costs and higher fees, 2/3 underperformed. Now, talking about small company stocks, those numbers are even worse. Less than a fifth of small company active mutual funds outperformed its small cap index benchmark. Really dismal numbers. In fact, what does this mean? It means that investors like you are starting to realize this and to see an active management mutual fund manager is not so happy because you're getting smart. $48 billion, 48, not million, but $billion flowed out of active management funds so far in 2018. And why is it? Because like I said, we're starting to realize investors are starting to get that message of what we as financial planners have been talking about for decades, that costs and fees matter, and that there's a randomness of returns. As we saw last year, emerging markets were our top performers, a 37% return. However, only 2 years previous to that, you can see that emerging markets did extremely poorly. So it means that it's not an option to not have a diversified portfolio, because a diversified portfolio helps you sleep at night. It minimizes your risk over time. It maximizes your returns over time. And it lets you do exactly just this. To sit on your sailboat, and this is my little brand new puppy, she's 4 months old, Matilda. To sit on your sailboat, to look out, relax, maybe even take a nap up in the cockpit, and think about the things that are really important to you, like spending time with your family, like going around the world and traveling, like taking care of yourself. That's what you should be focusing on. And diversified investors are able to do just that because they know their money is working for them in a robust, well-diversified way. So if you're unsure if you are a diversified investor, I ask you to please look into our second opinion service. 80% of individuals say that a second opinion about their investment portfolio would be helpful for them. You will receive a personal analysis of your current situation at no cost. We look at every single holding, the fees within there, the risk, and whether you are on track to reach your goals. We do this because we find that one of three things can happen. Number one, it could be that you're invested beautifully and there's no reason that you should leave your advisor or have advisor help you. You can do it on your own. Number two, it could be that there are some changes and that your current advisor is not necessarily the wrong fit, and we could be the fit for you. Or it could be that there's a few tweaks, a few things that need to be made. Your current advisor isn't that person, isn't serving their needs. You don't feel like they're really talking to you or hearing you out, or somehow feel like there's a disconnect, and you know that you need someone else. So please feel free to reach out to us. We are part of NAPFA. We're fee-only financial advisors, fiduciaries. We are part of the Financial Advisor Council and have been so for CNBC for many years. We've received the Women's Choice Award, pro bono awards for our volunteering and helping. We've worked with thousands of individuals, helping them in a pro bono basis. Top marks for our wealth and money management, and that, of course, for medical individuals too. So please do reach out to us. We have an award-winning team. We would love to help you. And here is our information. You can reach out to info@francisfinancial.com, or you can email me, Stacy, STACY, @francisfinancial.com. Again, STACY @francisfinancial.com. And feel free to visit our website, www.francisfinancial.com. I'm Stacy Francis, the founder and CEO of Francis Financial. We're celebrating our 16th year working with phenomenal, wonderful clients with the best team I could have ever imagined being able to put together. Thank you for your time. Thank you for your trust. And if we can support you anyway, please do reach out. Thank you.